really mumble, so by like page
Welcome to
4,
Digital Hollywood, Day
I
One.
just put you set up page 2.
And this panel is entitled VCs, Private Equity, Corporate Investments, the Funding and Accelerating the Content and Technology Marketplace. So I think we're going to be here for the rest of the day to fully cover the subject. We're actually going to try to do it in an hour. And this is one of those days where everybody on the panel showed up. So we're going to try to give everybody equal time. I've been doing this opening day panel, sitting here doing a moment of reminiscence since 2005. So I see a number of you in the audience who actually I remember back from those early days. Somehow we don't look the same, but then neither do I. In any event, welcome. My name is Larry Gerbrandt. I'm principal of Media Valuation Partners. I sit on the board of INSP TV, which is probably the most successful basic network you've never heard of. 79 million subscribers, top 40 Nielsen ratings, and nicely cash flow positive. So, and I'm also working with Seth Shapiro on a startup called Alpha Networks, which is going to bring blockchain to the OTT marketplace. So that's me. We're going to have each of the panelists in turn introduce themselves, their company, and where they fit into this finance marketplace. We'll start with Jason.
Sure. My name is Jason Anderson. I work for Pursuit Advisory. I was one of the founders. We focus on corporate development with our clients. Our business practice essentially extends from strategic work around business model maturation all the way into raising capital. Examples of our work, we are the ones that created essentially the new company Fandom, which you guys might be familiar with, and they raised $150 million. We worked with them for 18 months, rebuilt their strategy, rebuilt their brand, rebuilt their whole company, and then went out to market and raised a huge amount of capital. We worked with Vice, Refinery 29, a lot of the world's biggest sort of new brands in digital, as well as with traditional brands from 0.0 to Meredith Corp to Time Warner, et cetera, et cetera, et cetera. That's me.
Gregory?
Great to be here. I'm Greg Bedrosian. I'm a managing partner and CEO of Drakestar Partners. We do a couple things. First, we focus exclusively across the tech, media, digital media, and communications sectors. We do both private equity co-investing, so our firm and its partnership will invest between 25 and 100 million, as long as it's alongside a lead investor that we know and like. The other core part of our firm is the advisory side, where we're providing M&A and corporate finance advice for a lot of the great growth stage companies across the tech, media, and communications ecosystem. The other element is we are a global firm. We have 10 offices worldwide, most of them here in the US and in Europe, so cross-border activity is another core area of our focus. Great to be here and look forward to sharing views on the panel.
Paul?
My name is Paul Hansen. I'm the CEO of Covert Media. We're principally a feature production and financing company. We have our own international sales group as well. We've started branching into television as of about a year and a half ago. As well, we're backed by a private equity fund and finance most of our features and our content, usually through some combination of the capital that we have, but we also syndicate through sort of a network of other PE and VC partners that we usually work with.
So I'm Christopher Howland. I run the entertainment vertical at Pacific Mercantile Bank, located in Century City. We finance film and television projects, as well as offer lines of credit to companies within the media and entertainment ecosystem, including film and television production companies, foreign sales companies, entertainment law firms, VFX houses, post-production houses, small animation studio, and that's about it.
Megan?
Hi, my name's Megan Jones, and I say I have a very checkered past. I grew up mostly in Silicon Valley, and my dad's been in the high-tech industry his entire career. I went to law school and I graduated and passed the bar, but I immediately became an investment banker in Silicon Valley. So I did early internet stuff before there was more than just like an internet group, and then it broke into B2B and B2C, which was like major at the time. Then I decided to go back to law school, get a tax LLM, so now I'm a lawyer that does a lot of work with companies of all different types, startups, older, more established companies. So I always say my clients are the type of companies that people want to buy, and I try, whether from the finance side or from the legal side, just to make sure that they make the right decisions and are protected.
Good morning. I'm Skylar Moore. I'm a lawyer partner at Greenberg Glusker. I marry movies with money. That's what I do. I'm the author of a book called The Biz, that if you don't have, you should get. It's just a good overview of the film industry and the new digital world. I'm a author of a blog on, or not, kind of a column on Forbes, and I am an adjunct professor at USC Law School, and I deal all the way from financing independent films to large studio slates, and I've done some of the pretty large transactions. And in particular, a lot of cross-border. I ride the various waves of, India and China and almost Saudi Arabia until that just died. So that's what I do.
My name is Pallavi Shah, and I am a Senior Vice President at Houlihan Lokey. Houlihan Lokey is a global investment bank with publicly traded with about $1 billion in yearly revenue. We do focus on M&A as well as capital markets, valuation, and also we have strategic advisory services. So I am part of a group called Tech Plus IT Group. So back in 2013, there was a little company called BSIP. It was an investment bank focused on advanced technology and intellectual property. And in 2017, January of 2017, Houlihan Lokey acquired that company. And I'm part of that company, which is now called Tech Plus Advisory Group of Houlihan Lokey. And I run the transactions. So most of my transactions are intellectual property and advanced technology. So my background is engineering, and I worked at Sun Microsystems, which is Oracle, on Java, advanced HDTV standards, interactive television, and technologies related to those. And then gradually moved into doing the transactions, buying and selling companies and technologies. Thank you.
Thank you. Before we start with the actual panel discussion, I wanted to let you know that we're probably going to go to the audience fairly quickly. We're not going to leave it for the last 10 minutes for your questions. Having done this panel a few times in the past, I found that your questions are very often much better than mine. So while I've got a nice full list here, we won't run out of topics, especially not with this many great panelists. We do want to get as many of your questions in and answered as possible. So for an opening question, we're going to start at one end and move down the other, is really a stage-setting question. And that is, what's been the biggest change in the marketplace from your perspective in your sector over the last 6 to 12 months? Jason?
Sir, I guess saying it really, really simply, it's this shift in the value drivers or the perceived value drivers, both in terms of corporate partnerships as well as capital around audience and content. Historically, if you go back, I started my career in venture capital many years ago working for Gartner, a big IT firm, but the way they look at content, or you look at audience and the underlying technology in terms of sort of a growth curve or a maturation curve, there was a lot of excitement around new forms of content, new points of intersection with audiences, and it created a huge amount of capital flowing into the market, lots of new business models. And now, as we see, partially through the consolidation at the major tier of media, but also down at the lower level, there's just uncertainty around how people are going to consume and what kinds of content people are going to consume. And the primary thesis where we thought we understood this shift towards OTT, or this shift towards social video, or this shift towards deeper analytics so that we could really churn audiences and drive value against them, are now being questioned once again. And it doesn't matter if you're a regular way production company or a movie company like some of these people focus on, or people trying to develop the next generation of media consumption models like my clients are doing. When you intersect that with capital, who has to drive value and have to drive returns, everything is turning into like a mess, or as I call like a militaristic term, into the soup of the market, which means no one really has a view, everyone thinks they're right, and capital is just kind of freaked out and backing away. That's the biggest thing I think I'm dealing with. Because there are great business models out there. It's about perception and stomach, as I call it, risk tolerance for people. Now, when I was a left fin banker, everyone's risk off now, except for very specific kinds of deals. And it's hard month to month to know exactly what that specific kind of deal is. And I'm sure the bankers who sit on the panel, and I'll stop here, they're going to be way more granular about what I just said means to you guys. But that's me. I work more on the front lines with my client, building business models that were always focused on financeability. So in that, under that curve and that sort of optics, that's what I worry about.
Hot mess and everybody having their own opinion.
Yeah.
I think you just described America, but we won't go there right now.
That's not
I'll just add briefly to that, because I think that was a super overview, and I'll let my other panelists add in. But I would say from our private equity co-investment lens, it is very challenging within that ecosystem to evaluate and fund transactions. On the M&A side of our firm, I think we're also seeing strategics making more defined bets than financial investors, either because the strategics feel they need to, or they have a different lens through which they're transacting. So that means there's uncertainty. That also creates opportunity for those, but it is a complex environment. I agree.
Paul?
I guess I'll sort of add to the soup a little bit from our perspective, which is I think probably the biggest fundamental shift that we see, and it really didn't start in the last 6 to 12 or 18 months. This started years before, but it's really accelerating, and that is sort of the increasing inability to risk mitigate in the new content space, which is historically, we've used mechanisms like pre-selling either territorial rights in the foreign markets or pre-selling ancillary media windows like the television rights to content to risk mitigate, because you could cover a portion of your negative cost financing, whether it's feature or television, by pre-selling those distribution rights. What we're seeing now, and it is happening very, very fast, is dramatic value compression in the ability to pre-sell things, whether internationally or to television windows and things like that. And as a consequence, there's less mitigation of the risk, and the cost of making things isn't really going down in certain parts of in the media sector. The cost of making a movie, particularly if you're shooting in a union-based area like the United States, is not going down really. It's only going up probably. And if you're not able to risk mitigate by pre-selling international the way you used to, the only way you're filling that is with equity. And that's a very dangerous thing, and the risk profile of that capital is becoming less and less attractive. And I think that might be one of the reasons you're seeing strategics playing in M&A more than the financial players, because I deal with both. And a rational financial player looks at this space right now and wants to just throw up their hands, because it is really hard to justify the risk profile of the things we do, particularly in the new content space. For things related to infrastructure or VC, like technology or libraries, maybe that's less so. But in the new content creation space, it's very scary right now.
Christopher?
I would second everything that Paul has said. I mean, just because we're really, a lot of what we do is actually linked to companies like Paul's. In recent years, banks have lent against unsold rights or projected rights for films, and that was a pretty reliable source of collateral. But now with, again, streaming companies coming in, that's engendered a great deal of consolidation within the industry. it's meant that, buyers around the world that might have pre-sold the rights to a film, before the film was even created, are now holding back because they know that one of the streaming companies could come in and just, want to scoop up the worldwide rights, and then all that money that they put towards their marketing for the coming year is all for naught. So I would say certainly the greatest impact for us has been just, buyers around the world are certainly, taking a second, look at the rights before they buy.
Megan?
So I'm going to go, I look at things from a little bit more of a Silicon Valley lens, so I'm going to put my little Silicon Valley glasses on for a minute and try to speak into the microphone. I forgot to say my firm name, by the way. It's Clark Trevithick. I'm in downtown. The first trend I kind of see is the institutionalization. And I think there's always institutionalization when you're looking at investors, because at the end of the day, right, they're not there because they like the content or they like the platform. They're there because they have to make money. That's their job. And where I'm really seeing institutionalization is, so break it apart. There's the content side, and then there's kind of the platform side. And I think the platform side is just crazy fragmented, right? We still use our phones. And I was thinking about this as I was waiting for this panel, because I called one of my clients yesterday, and I got a disconnected number, and thought that was weird, so I didn't know he was moving, and I called his cell phone. He said, yeah, I decided to shut off my phone, my main line, because it's just all telemarketers now. And I was thinking here, I was like, gosh, I have these 2 TVs on my wall, and I don't even remember the last time we turned them on. Like, why do I even have them there? And so I think the platforms continue to evolve, but we're still really looking at the basic platforms. But with the content, I saw these numbers. So when you look at who's watching what where, Netflix is 27% of the respondents said that they watched, the streaming media, or not streaming media, they watched the content. Then basic cable is 20, broadcast is 18, and YouTube is 11. If you're looking at people 18 to 34, Netflix is 40%, and YouTube is 17, basic cable 12, and Hulu 7, broadcast TV 7. TV viewing dropped 32% between 2010 to 2015 by those 18 to 24. So, when you're looking at content, you're really institutionalizing it, aren't you? Netflix is really controlling a lot of it. It might not be the big studios anymore, but it's now the big tech companies who are behind it. The other thing that I always think is weird, I look at numbers, obviously, because I'm a numbers girl at heart, but deals are just crazy, right? We all know that there are all these big, massive venture funds out there, but they're putting increasingly more and more money in the later stages. Something like over 50% now is going to kind of that last stage of company. And you still have kind of growth at the very, very early, young company level. They're seeing an upswing in financing there too. And they're even slightly higher deals, $2 to $7 million. But really, the marketing money is going to those bigger startups that are not really startups anymore. The other thing, I'm on a panel, I'm moderating, it's kind of a last-minute thing this afternoon, on content and branding. And I thought something was really interesting when we had the call before. One of the people there, and this is what Sky's going to cover, was the internationalization of the market, where one of the people there said 10 years ago, the international market was 10% of, I guess, I don't know, global box office. Like I said, that's what he'll cover, not me. But now it's like 90%. And I thought that was a strange figure to quote. So that's something that also matters, right? If you're going to create something, is it really going to be just for the US audience, or can you sell it internationally? And I wonder, I didn't really research this, but I wonder if some of those unicorn companies are getting those billion-dollar valuations because they are so globally focused. I think the other thing that I wanted to mention, since we're in LA, we've had 2 down quarters of investment in LA. I looked at the numbers. It's something like, what is it, $800 million. But we have lots of really little deals. So it's kind of skewed when you compare it regionally, where we have less money coming into a lot smaller deals. And I don't know if that's a good thing or a bad thing. I guess it's always good to get the money, right? And then I think the other thing, there's terms that I haven't really heard so much. So one of the things that, and I'm going to stop in a second, one of the things that we were going to get asked, and we're going to get asked about later, is kind of all these different artificial intelligence, interactive experiences. I personally, and I will be curious to hear if my panelists disagree, I personally am hearing less of that from investors.
Okay, thank you, Megan. Sky?
Give you good news and the bad news. Start with the bad news.
Yeah, that usually softens the blow.
Okay, here's the bad news.
Yeah.
Here's where money isn't available. cryptocurrency, it's all bullshit, right? All of it. The moment you hear it, run. Cryptocurrency, did I mention cryptocurrency? Theatrical is gone. Theaters are gone, dying, going. Pre-sales, which I've lived and, profited from for years and years, go to Cannes, go to AFMs, pre-sale your film, gone. Gone. The whole pre-sale market has been wiped out, literally. Saudi Arabia, gone. China, gone. Russia, gone. What's up? All right, so let's give you the good news.
North Korea?
Yeah, North Korea. Coming. Coming. They're coming into South Korea, actually. So here's the good news. The good news is that in the last year, I have raised, or my clients have raised, millions and millions and millions of dollars from private equity guys in the U.S., private offices, wealthy guys buying a credit. And I have sold more credits. That's what I really do now, is I broker credits. For $5 million, you can get a producer credit on a big film. And people will pay for that. And I'm now selling in credits, associate producer in credits for $250,000. I mean, it's hilarious. So you get rich family offices in the U.S. have been putting, you just can't believe the amount of money they're putting in, and really fundamentally, it's either ultimately to get a credit, or in some fantasy, they get on the, get an Oscar somewhere. Literally. When you get to their heart of hearts, they all want to get on an Oscar stage, and so if you can sell them that dream, and if you can't sell them that, you sell them parties and premieres and some fun and a date or something, and they just love that stuff. I mean, you can't believe the billions that comes into Hollywood chasing that fantasy. And so whenever we go out with a film offering, we always sell the hype. Well, you get a credit, and you're going to go to the premiere, and oh, woohoo, oh my God, you get to go on the set. Oh, wow, for a few million dollars. I kid you not. I kid you not. So that's good news. Second thing is that's happening is a huge shift going from theatrical to TV. Everybody, if you're not in it, man, you just move from theatrical to TV, because the pre-sales are dead, theaters are dead, but TV, and it's just become a digital world, period. It's a Netflix, Amazon, Hulu, whatever, it's absolutely a digital world. Digital dollars are taking over. The whole world has shifted to digital, so I just tell everybody, you want to go raise money, just go get on your knees and go to Netflix, and try to do an output deal there or something. And I have had some big budget films, we were heading for theatrical release and then veered off to the digital world. Like a big one was Irishman. I was doing The Irishman with Martin Scorsese. The budget got to enormous numbers, and it just could no longer work in the theatrical world, and off to Netflix, it went. So digital dollars, absolutely huge. And in terms of changes that are coming, the big change that is coming is the gorillas coming into the over-the-top space and digitally. If you look at Disney Fox in the last 6, that's going to be an earth shift in a year. When they go out, that is going to be a massive change. Comcast Sky, Warner AT&T, Apple. When Apple hits next year, I mean, the whole digital world is going to change, and in particular, Netflix is going to get hammered, because they are one trick pony, and you're going to have some players in there that just have massive content and massive pockets. So it's going to be an interesting world. And what that tells you is that there's going to be a demand for content for all these new online digital companies. I mean, there's going to be a massive demand. So in the short run, for at least a couple of years, until things get sorted out, there's going to be an inflationary spiral with respect to TV, digital content. That's why there's such a proliferation of the number of series right now that will sort out, and it will obviously die. I'd say in 3 years, that's going to absolutely, crash. But there's going to be a party for at least 3 years with digital dollars. And then the next wave beyond that is virtual reality. So and it'll be location-based VR, And if you want to see an incredible example, you either do The Void, or you, for a walkthrough experience, or a program called Arizona Sunshine, where you shoot zombies and you work with you go on a date, you do it together, and it's a fantastic experience. So that's the future, but that's 3 years out.
Are you short Netflix?
Yes, I have. Yes, I have, in a big way.
Pallavi?
So I'll dovetail off of that. So there's a lot of talk about the market jitters and capital getting pulled back. And what we are observing is, because Houlihan Lokey's biggest market is private equity firms. And so they have this fund called Alternate Investments. And within that fund there is another fund called Special Situations. So what you'll find that as the market is pulling back a little bit, there's more interest in those special situation funds, and a lot of private equity funds are starting to invest in intellectual property. So usually you wouldn't see those financiers, meddling in engineering and high tech, but all of a sudden you see multiple bidders for some simple licensing program, IP licensing program, and only one wins. So we're seeing a lot of momentum there with regards to intellectual property. And I think there are two reasons. One, of course, the market is not sure, so they're looking for something that's not correlated to S&P and the standard market. And the second is the China phenomenon, right? So there is, the economies are shifting from manufacturing to engineering and services-based economy, and the core of that is intellectual property. So they believe that would really stay stable, and it won't have the effect of the market jitters. So that's the reason we see a lot more traction there. In terms of what technologies are getting the most traction, and so that, because we talk to so many operating companies as well as investors, we kind of have a view of 2 to 3 years down the road, what kinds of products are going to come to the market. So the areas where we see a lot more traction is artificial intelligence, AI, AR, VR, but more on the augmented reality than just virtual reality. Within virtual reality, there's more hardware as opposed to just software. All the communication technologies, starting with 5G and IoT, we see a lot of traction there. Interestingly, you'll see a lot more traction on the content because of autonomous driving. So a lot more action in autonomous driving. Everybody is looking into investing in that, lot of technology development, lot of investments. But now the people are not going to do anything in the car, so what do? Entertain them. So there's a lot more new type of content that's more relevant to that kind of an environment, where you don't have the best sound system, you're on the road, and lot of creativity there, right? You could play with someone in the next car, or you could play with someone who is in China, and and create content that's more interactive for that moment. So you'll see some traction there as well.
Thank you, Pallavi. It's funny, Sky, I was reflecting on some of your comments, and from my point of view, nothing has changed in the marketplace. The very first project I ever worked on was when I was running a small production company in Dallas, Texas, in 1978, and one of the very first projects was doing some work on a movie, I don't even remember the name anymore, but a rich Texas oil man had decided that his daughter had talent. She was blonde and cute and Texan, and it starred her and 4 Dallas Cowboys. And he fully financed the whole thing, and to my knowledge, it was shown once at the premiere in Dallas.
We love those guys.
Yes.
We love
Well,
those guys.
so did I. I mean, I got paid. Anyway, that's what my point is.
Lots of them.
I'm not sure that aspect of the business has ever gone away. I wanted to do a quick poll. How many people in the audience are looking to raise money for a project?
Can you ask how many are technology versus content?
Oh, good, okay. How many are looking to raise content funding? And how many of you are looking to raise funding for some form of technology? Well, it's pretty much a 50-50 split. How many of you have content or something that you want to sell? Okay. Okay, so the question for the panel, with that perspective, is, and we're going to start with you, Jason, and again, work our way down. What does the ideal presentation or proposal look like that is actually likely to get funded or a deal done?
Sure. In my world, again, we focus and tend to focus either with large corporates or with highly funded entrepreneurs only. So if you have $2 in a dream, we tend not to interact with you. So keep that in context, meaning don't think what I says has to apply to everyone in this room. You need to go home and spend 50 hours building this thing. Honestly, at the end of the day, now that capital has become much more aggressive about essentially not checking the boxes, but deeper levels of diligence, you could call it, or industry analysis, the biggest differentiator that I've seen now isn't a pretty face, a cool idea, and a pitch. It's actually some sort of proprietary viewpoint around the structural nature of an industry and an opportunity. And to say that in a less highbrowed and like pedantic way, it just means, have you really done your homework and have a view that's different than 10 other people haven't already figured out? And the way when I worked in venture, my boss said it, Jason, no one who walks through the door is really that special, because calculus was created by two different individuals simultaneously that didn't even know each other. So let's be realistic about what people actually know and understand and what their intent is. They have a dream and a desire and a certain amount of time to focus on it. But I would really focus on what is that quintessential element that everything around your idea turns on that is truly different. It could be a personal experience you've had, some esoteric data set or knowledge with regard to IP that you might have. It may be a viewpoint around thinking about audiences differently that you're pulling out of our cultural understanding. But there needs to be something different. Like this whole thing, now particularly in the markets, like the social media haven't figured it out, but this whole make it to, fake it till you make it thing is dead. Capital isn't sufficient enough any longer, and as we've talked about, the reason why, there's real reasons why there's only certain kinds of capital available for specific times. If you can actually go back and sit with an academic at MIT or Harvard, and they can explain even the venture capital cycle to you. There's books on this stuff. So the reason why there isn't capital, there's reasons for it. Ignore that. Figure out what your idea is, what it is that it's really, really different, and be honest and self-aware. If you don't have something that different, go back to working what you used to do. I wanted to be a novelist when I was 19. I was really good at math, not at writing. Where did I end up? Investment banking, venture capital, and then now doing what I do. It all makes sense. So I would focus on that. Do you really have something special, and are you being honest with yourself, and how do you quantify that? If you can quantify it with math or with a cultural impact or a change in the world, then you probably have something that's going forward and it'll be massively changing. Anything else that you can't answer that story to, it's probably just incremental, and you should just ask for context for yourself. If I'm just trying to create more content like this, then you should draft in that pathway. Go to strategics, go to people that ultimately can help you bring your vision forward, but don't need you to build a brand new business, some technology that's gonna beat Google out in their AI division. Forget it, it's crazy. Focus on what you can accomplish, what's realistic, and what comes from your soul and your heart, and that at the end of the day, when you stand in front of the mirror, you go, this is real. I don't give a shit what anyone else says. Then you can run at it, but it's hard, it's still low, sub 1% probabilities no matter what. And that's the beauty of life and doing what you're doing and why you're in this room at the end of the day.
Greg?
Wow, that's a hard one to follow.
And I'm a substitute, so the partner was here. Yeah.
So I would add a couple of thoughts. And again, our firm would probably focus on slightly more mature opportunities than many, but not all of you probably have in the room. First of all, what I would say is, and I'm a co-founder of my current firm, and many of us here are entrepreneurs, so I applaud anyone and all of you out there that have an idea and are building or developing. One of the lessons I learned and one of my mentors shared with me, it's relevant for the content business, it's relevant in technology up in Silicon Valley and everywhere else. An idea tends to take twice as long as you think, and it costs at least twice as much as you had originally planned and penciled out. So one of the things that we always see is someone with something that's partly developed, some good kernels, and they're kind of running out of cash. And that's sort of, as an entrepreneur, the vice and like the worst place to be. But it happens all the time. I'll leave it brief and let my other panelists kick in, but the rule of two, as I call it, things take twice as long and are twice as expensive. Plan for that going into the process so that you don't end up with a great idea and a desperate financing situation where your idea could be lost.
Paul?
I'll speak very specifically to content. The technology side is not really my field of expertise, or at least isn't anymore. In speaking at a lot of these panels, the audience tends to be people who are just trying to break into the industry. So I'm going to make a very specific point now, which is unless you have very specific relationships in the industry where you can get to higher profile talent, meaning writers, directors, or actors, you're probably trying to put something together on your own or with a group that doesn't have a whole lot of inroads into the industry. My advice to you is either get someone who can be your champion, who can navigate the industry, or frankly, because the technology is so readily available now, go just make your thing as cheaply as you possibly can by beg, borrowing, and stealing. If you're trying to make the next $20 million feature film with a big star or a big director, I think you're going to face too much headwind that you should probably not approach the industry that way right now. You have to kind of get your foot in the door first, prove that you can do it, and then get there, because you are competing with, besides the studios, the well-heeled production companies, unless you are incredibly wealthy or have an incredibly wealthy backer, you're also competing against people who are willing to throw money at, as Sky mentioned, throw money at this situation just to get in the door, and that's very hard to compete with. They'll get the star, they'll get the director because they're overpaying them and probably paying them more than even Netflix is paying them right now. So, but to get to the core question of like, what are we looking for? How do we focus on content? Like, what do we think works? I think the trickiest thing right now in the industry is who is the audience that you're going for? And that is a very difficult question to answer. I think even Netflix probably struggles with this with all the data that they have. In terms of how do you match the type and tenor of the content with the audience who's going to consume it and how they are going to consume it. And that's why you see this sort of vacuum in the middle market, if you will, between the sort of the Get Out, Blumhouse, genre, low budget films and the Marvel, Pixar, Lucasfilm kind of films at the other end of the spectrum. The stuff in the middle, which used to be a big part of the industry, and I encourage you to frankly read Ben Fritz's book, The Big Picture, which talks about this in great detail and uses a lot of information he gleaned from the Sony hack. The reality is the audience for the middle right now is really hard to get to. They're the ones who aren't going to theaters. They may or may not watch it on a streaming platform, and how you tie their sort of consumption pattern to what you're making for them is really difficult. So what we spend an inordinate amount of time at my company, and I think our peer group does the same, is thinking about the 2 to 3 year development and production time horizon, and think about what are we putting in now, and how are people, who's our audience going to be in 2 to 3 years, and how do we try and build a business case and a thesis that matches what we think the consumption of our content is going to be 2 to 3 years from now. And you look at the pace of change, that's a very difficult bogey to hit because there's so much volatility in the marketplace, but we do our best to think, okay, well, we know we're pretty good at making stuff because our films have succeeded in the past, and we've done them for the right price, but figuring out what you're making and the budget you make it for, I think everyone is struggling with. I mean, every weekend at the box office right now, you're seeing a major studio with very seasoned executives probably making a mistake. And that's a frightening thought that the hit rate is so low right now.
Yeah, you just explained to me why I see so many post-apocalyptic films on Netflix. 3 people left on Earth, and they're trying to figure out how to get, to somewhere else. It really cuts down on casting. Okay, I mean,
Can I just say one thing to your comment? I thought that was brilliant. That was really smart. One thing I would add for people that are focused on the content side and have a concept for a story or a piece of interactive content or whatever, don't feel like you have to stick to medium. Meaning, I've seen people take great stories that they wanted to be an unscripted piece of product or scripted piece of product or theatrical and go to someone who needs that content on their platform. Like one of my clients has 200 million people a month that come there to consume stuff on movies, television, and video games. If you're making something that connects to those genres, they will give you money to make a 5-minute little piece of short form content, an animated video, something that captures your story, circulate it across their audience. And to his point, if you don't have relationships with an agency or you don't have relationships with wealthy producers or parents, how do you get awareness? Because at the end of the day, the studios don't really care about that stuff. They're just looking for connectivity to audience or proven track record. If you can get a piece of content that you make cheaply that represents your story and really reflects what you want to say and you put it on a big platform, YouTube, fandom, any of these, and it draws audience, that's your calling card, because that's the massive differentiator. It's the same in music, television, and movies now, where they use those platforms to source talent and source story because the agencies can't do it on their own. But it's a 2% probability scenario, even if you're successful in draw audience, because as he mentions, the system within which most media is created at the higher level is very stratified, and the middle section is still, again, not making as much because they're looking for audience. If you tell them who your audience is and prove that you've delivered it, same thing at a record label. If you show up and you're Justin Bieber, proof you get a deal. Same thing. And if you can move audiences around, meaning if you can do it 2 or 3 times, a la like what Chernin does at Crunchyroll, and show that there's actually a huge global audience that Netflix doesn't understand or Cartoon Network does not understand, but your 5 little cheap pieces of video are capturing, even if it's 50,000 people systematically, that's a better calling card than sitting outside an agency or sitting another conversation with some rich person that's telling you they want to make a movie and you're just like, holy shit, I'm just labor here, you know? So that's just a suggestion to give you guys a pathway. It doesn't feel so daunting at the end of the day, given everything else that's been said. If you're content, technology, it doesn't matter.
Christopher?
Well, again, I would second everything that's been said so far. In my previous life, before becoming a banker, I actually worked for a company advising well-capitalized production companies, including Alcon and River Road and Black Label. Really, phenomenal companies, and frankly, companies which I think are, keeping the independent film arena alive. But in addition to working with some of those, high net worth individuals, I've also worked with producers who are, again, just trying to get off the ground, get their projects going. And speaking, specifically to that, sector of the market, it all starts with a script. You have to have a really solid script. And I'm probably one of the few bankers in town who will read your script. So I think that's where it all starts. You can have brilliant craftsmen, best in the world, but it's like building a building. If your blueprint isn't good, your movie's going to suck. I think the second part, and this has been spoken to as well, who are your relationships with? Which are you working with an agency? Do you have a foreign sales agent engaged? Do they have a sense of what the project's worth is going to be in the marketplace? Are there, pre-sales before the film is even being shot? That's one key element where, we always look at when we're looking to, lend to a producer is, what's the market for the film? I think the second part is, it's risk mitigation. And that means that you have at least 20% of your budget, your gross budget, is supported by equity investment. I think the other part is, where are you filming, in which country, which state in the U.S., because tax credits are key. Several countries, states are very generous in supporting their creative communities. So I would really recommend taking a look at, where you're going to be filming and where it makes sense, both, financially, but also just, for the film itself. But I think that's probably a good place to start. I don't want to sound redundant from what's been said already.
Megan?
Thanks. I am a little bit more optimistic than anyone else on this panel. So I did grow up in the land of milk and honey. My parents are both immigrants who came to this country and did really well. I was actually at a program that a friend of mine put on, and he had someone who was a billionaire who said that when me and my co-founder started this company, we each put $100 in, we had $500. A year later, we all would have walked away with that $500 and called it a day, and he became a billionaire. So, having said that, as you can hear here, this is a business, right? If you're looking for outside money, you are facing a business person, and they don't care if they like you, they don't care if, you're nice to them, they don't care if you return their phone calls, they might not return yours. So how do you break it down? First, you look at what kind of money you're looking at. If we're talking about something like artificial intelligence, you need a lot of money to develop something in that world. A lot of really big companies with very deep pockets are in that space, and it's hard to raise money to compete with them, period. It's like a Blockbuster. You can't really compete with the big studios. So what kind of money can you find? And that's where it's really your own hard work. That's where you can Google different types of venture capitalists, different types of investors, different types of lawyers or contacts that you can make, and figure out actually who funds what you're trying to do. And then you figure out, is my idea competitive? I have a long speech, which I'll make really short, which is if your idea doesn't fit on what someone can read in that little line on their phone when they look at all the emails they've gotten, you don't know what you're doing. You need to compress it into that. And part of it isn't personal. Again, if I was trying to raise money or trying to help a client raise money, and they want to invest with someone who only does biotech, it's not worth their time to talk to that person. You put biotech in that little line, that's all you need. You're going to get that email opened. You might not get an investment, but that's what it'll take. And then also, what makes you competitive? When we were telling companies or, idea mavens or, anyone, what makes you competitive? First, you have to look at your market, right? If you have a niche goat video, obviously that actually can be a huge market, who would have thought, but you have to know who you're marketing to. Marvel is recurring all the time because it's a huge market and people go to those movies. So if you have a small market, it's not a bad thing. It's just a different amount of money you're raising and a different investor. Do you have something proprietary? That can be a whole lot of things. And it's not just why I have an interesting idea for a script or I'm a really good writer. It's something that sets you apart. Then who are you? And this is where life isn't fair, right? If Steven Spielberg walks in here and says, I've got an idea for a movie, we're all interested. He's built that reputation. So who is behind you? Whether it's relationships, whether it's what you've done in your own life that you can, show someone that will lead them to believe you'll be successful. Who are the people behind the project? Then the financials. What's the cost? What's the real ask? This is a hard thing to grapple with. But if you go in and ask for a certain amount of money, I hear it all the time. I need $1 million. I need $2 million. And then you ask, okay, what are you going to use that money for? Why do you need that amount? And a lot of times it's a random number. And that's where you can get absolutely decimated in a meeting because it shows you haven't done your homework and you haven't really thought about what that project is actually going to cost. And then the last thing is is there a change or a shift in the market that makes your idea extra special? And here, we've talked about a couple of themes, which is, okay, we've got the big screen, and we've got the small screen, and we've got the really small screens, and we've got that middle market, which we don't really know what to do with. Well, maybe you can figure it out. There are a lot of people who figured out those types of problems and found a way of coming up with an idea and selling it. And so that's still an option. It's just a really hard option, and it's kind of what your pain point is. How long do you want to be an entrepreneur? How long do you want to be a dreamer? How much pain can you take? How much do you want it? And that's the practical reality. All of us here, I would guess everyone on this stage has a graduate degree. We're probably not the most risk-oriented group out there.
Thank you, Megan. Sky, aside from a rich uncle, what other advice do you have for what the deal that you're looking for looks like?
Yeah, I'm going to address this to the people who have content looking for money, so the half of the audience that raised their hand. Here's what to do. One thing you don't do is run around with a script looking for money. Ain't happening, all right? You need to package it. You need to show up with an actor, a director, and a producer, and you can be the producer, but you need to show up with a package. Do not just run around with a script. How do you get an actor and a director? You need to, the gentleman said, you need to partner with somebody who has traction in town. You partner with some producer that has that the agencies will return their calls. all right? And you just partner with them and be glad if you give them, if they take 50%, whatever, be happy, because now you're going to get traction in town. So that's step one, and you've just got to package it and get actors and directors. Second is differentiate yourself, create visuals. People love PowerPoints. To me, they're ridiculous, but you can't believe that at least that like separates you. You've at least shown the ability to do a PowerPoint, right?
That's a very high bar. For
Which are very high bars. Okay. Now, if
Books
you really want
definitely
to
go a long way.
yeah, you want to go like for the real guy, create a trailer. Like when a client walks into my office and they've got a trailer of the visuals of what they're planning to do, you can't believe, just even if it's a minute trailer, what an impact that has. Oh my God, this person actually managed to make a trailer, okay? So the more that you can do with their visuals or a trailer or something, you will differentiate yourself from the pack. Emphasize, now who are you looking to for money? You have two roads. Road one, digital dollars. You're just going to walk up to the Netflix's, Amazon, Hulu's, whatever, and you're going to look for them for financing. That's one pitch. You're ready. You've got your visuals, you've got your package, you're good. If you're going to go, if that doesn't work and you're looking for equity, you need to be professional and put together a LLC, limited liability company. You need to do it correctly. You need to have an operating agreement. You need to have a private placement memorandum. You need to comply with the securities laws. You need to be professional about it so that investors take you seriously. But when you show up with them, you want to emphasize the sexy aspect of the industry. You're going to emphasize, oh my God, you get a credit. Oh my God, you get to go to the party and you get to do this and you get to do that. That's what you emphasize in colored pictures and whatever, all right? But what I do see, I see a lot of people just, I want to raise money, but they're just so unprofessional about it that no one's going to take them seriously. So it's a combination of packaging, visuals, and professionalism.
Good summary. Pallavi will finish the panel and then go to the floor.
Yeah, I'll be brief. So we'll go from Hollywood to Silicon Valley. And here the kinds of companies that we love to invest in, or our clients love to invest in, are early stage. A lot of times they're pre-revenue companies, but their biggest differentiator is their technology, and a lot of times that's protected by their patents. So anything that, again, in the areas that I mentioned earlier, artificial intelligence, AR, VR, like just to give you an example, artificial intelligence in Q2 alone, this Q2 of 2018, investment in artificial intelligence rose by 21%, venture capital investment. And a quarter before that, the Q1 of this year, it rose by 31%. So there is definitely, I would disagree with the other panelists here that you're competing with Googles of the world for sure, but there are a lot of little pieces that form the big technology, right? So you could be focusing on certain aspects of artificial intelligence that differentiates you from the rest of the world, right? So, and those do get traction, especially if you have protection through patents. Anything related to distribution is also very interesting, like anything, 5G, any technology related to digital distribution, different channels of distribution, better methods of aggregating the content, anything that differentiates your offerings from the standard market does get traction here. And most importantly, licensing, so there was a discussion about subscriptions. So in case of intellectual property, it is always about recurring revenue year after year, and licensing your IP, you are actually at a big advantage. If your IP is deployed by your competitors, you still get the piece of the pie. And that's something a lot of people don't think about, but that's something you should always consider when you are developing your technology. And most importantly, the team. They're looking at who is the inventor, who is the CTO, and who is the CEO, and how are they going to run this? Is this going to scale in the future? Is it repeatable business? Who are their partners? Is this technology validated? Is there a pilot? anybody liked what you've done, any of the top guys, what do they think of it? All of those things do matter.
Okay, thank you, Pallavi. We have at least one gentleman who's been very patient. Go ahead.
Yes, sir. First of all, I just want to say it's a real pleasure to see everybody here. My name is Life Griffith. Service executive safety veteran, worked in the music business for a very long time. In 2015, I came back home from Afghanistan and I moved back into the entertainment industry. My question is this. I went back to school to get my graduate degree in business and finance. And I've been watching the EU talking about the Yetta, a new level of technology that will knock out Bitcoin and Ethereum and all of them. I'd like to know, what do you know about the Yetta and how does it affect you being a venture capitalist or a person in finance?
And thank you for your service.
Thank you. Appreciate it.
Anybody want to take that?
Is anybody familiar with the Yetta?
The what?
Yetta.
Yetta, like a Yoda?
So while I was in school, as I mentioned, I've been watching what the EU has been doing. EU, European Commonwealth, right? So what they did was they spent millions of dollars investing into this new technology called Yetta. 1,000 times faster than Bitcoin, 1,000 times faster than
Cryptocurrency, if it's cryptocurrency, forget it.
Right.
Just
We
forget
know
it.
it's digital currency. And they said this is going to be the new premier way of dealing with blockchain technology and how we exchange transactions. So if you want to go to it, it's Yetta, YETTA.io. And so I've been watching that. I've been studying that, and I'm actually an investor in it. And the idea was, with you guys talking about finance and all these other things, how will that affect your business within the next, say, 6 months to a year, where the Yetta is going to change everything?
It won't.
Okay.
One of my favorite things to do to bankers, because I have a lot of bankers that I talk to, not investment bankers, but like banks, is start giving them a scenario where you like have a client who wants to transfer a whole bunch of cryptocurrency over, like, can they hold it in a trust? Can they hold it in this kind of an account? What if it comes from this country? You'll see them all freak out. It's still really a tough area. There's a lot of stuff that has to be worked out, and some people might make a lot of money, but this is where my dad's advice is really good advice. He says the people that really succeed in the technology industry are usually not the first movers. Google wasn't, Apple wasn't, YouTube wasn't, like none of them were, Facebook wasn't.
Yes, sir.
Question for raising investment capital. If you're, developing a piece of software, say, how far along do you actually have to have the idea and the data, or actually executed before you go knocking on, VC's doors to raise capital for that? Do VCs ever fund ideas and business plans, or do you actually need a tangible, workable product that's already being launched?
I'm going to jump in just because I was a client advocate for so long and still am. The longer you can keep that without seeking outside money, the better. Anytime you seek outside money, almost no VC I've ever heard of will sign a non-disclosure agreement, or non-compete, non-disclosure, none of them. They just won't sign anything. And if you go to some companies, yes, they've been known to steal. So as far as I'm concerned, if you don't need the money, don't get it. The best is if you never take any money at all, but that's not realistic. But that's just my viewpoint.
Go ahead. No, go ahead. No, go ahead.
Thank you. I have a quick question for all of you that invest. How many of your investors are actually putting kind of social impact conditions on your investment to shift kind of like the social focus of the content that you are putting money into and putting out there?
Yeah, I mean, I could talk about sentiment. Most people, most people other than select VCs, usually West Coast, Silicon Valley specific, care much less, because if you think about the structure of most investment vehicles and the way that they were built, most of them were raised many years ago. So this whole idea, which I think is a beautiful idea, critically important, and as a person who grew up in Asia, not in America, I truly understand and I'm happy that social impact is important to people. Most investors do not care about it. But institutional investors, the people behind the money, the ones that actually invest in the VC funds, they'll speak to it. There's Emerson Collective and firms like that, they do it day in and day out, but I wouldn't call them traditional institutional investors, although they do invest in that way. The big general partners, most of them, it's lip service, some of the younger people, and any fund that's been around for a while, they'll act, oh, of course we care, we're looking at them. And the reason why is if you think about the dynamic around social investing and the premiums it can allocate to some firms, it makes economic sense from an alpha or the IRR that drives the underlying fund to invest in these firms. If you're a VC and you're, say, stage 0 through C, you want to get behind that, because if you can't generate revenue momentum, if you're just selling a story, i.e. what's going on right now, social impact is a new layer of value creation. I can't find an audience, I can't really build a great platform, I can't really like figure out content, so shit, I'm going to be a social impact company and try to save the world. That was actually really popular for a while, and people could raise capital, and we would see it. We're very detailed and statistically oriented, meaning we look at how many investments have been done in exactly that kind of company. We look at who's invested in those types of companies. So we're trying to assess the market. We care less about general trends, because most VCs actually aren't that thoughtful about the investments they do. So we try to look at those things, and the reality is social impact has very little really impact at all. It matters to very few people. For select high net worth individuals and family offices, and for select certain kinds of investors that shift and start to feel more endowment-y or family office-y like that, for them, they care, and they'll select based on a weaker business model but potential for positive social impact, because they're balancing IRR, they're balancing alpha, it's a portfolio. So the math will work across a spectrum of assets, different stages, different focuses, different places and all that in their life cycle. So the hard answer is, if you're leading with social impact and you think that's going to differentiate you and get someone excited, it may for 20 seconds. And then it gets back to exactly what we've all been talking about. Is it a real plan? Is it really differentiate? Have you put the thought in? Are you doing something that everyone else isn't doing? And if it's a technology, does it look a certain way? If it's content, does it look a certain way? Because most investors at the end of the day need to move through a stack of investments each month in order to find the ones that they're actually going to invest in. So the hard reality I learned when I worked in venture, because I thought I was a PhD guy going in and thinking, oh, I'm going to save the world and do all these things. No. There was a very specific bogeys that we were all trying to focus on, and each firm knows exactly what they're looking for. And you just look at the partners. If they're mostly 45 years or older, if they're mostly skewing towards traditional Silicon Valley approaches, they will speak to it, but at the end of the day, it is success that matters. Because look at Facebook now. They started out happy and nice. All of them start happy and nice. All of them want to help the world. Then in the end, competitive realities set in. So VCs know that. They're not naive.
I hate to do this, we're actually out of time, but some of the panelists I'm sure would be happy to talk to you. I just want to leave with one closing piece of advice, and if you're completely, don't know what to do, exploit your children. No, this is serious. I have grandsons, and they are obsessed with whatever Ryan is obsessed with on YouTube. And I was at Target over the weekend, and he's now a line of toys. So he started out reviewing toys, he's like 6 years old, on YouTube, and now is a brand. So
For this one too.
there you go. Thank you very much. Thank the panelists.
That's interesting.